What a delight to be here today. This is our 16th annual conference here in Omaha. Our founder, as you know, Mario Gabelli, has actually been coming out here a lot longer than that, but we're very grateful that he could actually continue to sponsor this event, bring everybody here together. A lot of great panels, a lot of great intellectual sharing, and so thank you, Mario, for all of your sponsorship of this and leadership in inspiring to the next generation of Gabelli team, which is here today as well. So I think one thing that's very exciting and kind of in the world that we're living in is just the reach of this great community. And I was looking over the list when I first came in today, and we have people from the Nordics, from Europe, Asia, South America, the Middle East, Canada, Australia, and then we have all kinds of US states represented here as well. I wanted to call out a few, too, of my friends from this outing. First is Mark Moffett, who's sitting here. He's a San Diego Fire Department employee, and he has been coming here for over 20 years and joining us on our group. So an amazing participant. Here he is, right here, Mark Moffett. And not only is he just a titled fireman, but he takes care of the fires that are on the U.S. Navy subs, so a really important job for our government. Roger St. Pierre, I'd like to call out, I don't know if he's around. Oh, there he is, right in the front row. So Roger's been coming out for, I don't know, a long time, but we've been getting in line outside the CenturyLink Saturday mornings at 4:30, and we've never missed a front row seat in terms of that. So another great dedicated individual. So it's just, we come out here, we meet new people every year, but it's also great to have existing friends come and join us again. On your tables, you'll notice these plastic signs. So there you'll find QR codes for a link to our newsletter. We do a report right after this that comes out on Monday talking about the different aspects of what happened on Saturday's meeting. So that's a way of getting it, making sure on the list there. We also have the Wi-Fi information. And then are my teammates, you can see. And then also on the back, there's a list of conferences. So in addition to Omaha, we sponsor many conferences. And our next one is the media conference, June 5th. And so you can attend that virtually if you're not in the New York area as well. So also the content for friends and family that could make it, we will save this. It's live now, but we will save it. It'll be on our YouTube site on Monday, so you'll be able to review that as well. And then, again, my teammates are walking around from the Gabelli team. And you'll notice there's a taller gentleman here, Gino Torretta. And I don't know if you're familiar with him, but he was the second Miami quarterback to win the Heisman Trophy and lead his team to an undefeated season back in 1992. So he's quite an exceptional person and obviously knows how to win. So please, if you're interested in sports and finance, go up and say hello to Gino. He's a great guy to say hello to. So we're going to get the program started this morning. I had a quick question. So everybody in the room, if you could raise your hands if you own Berkshire Hathaway stock. Wow, okay, no question about that. Now, how many are you going to buy See's candy and bring it home to your friends and families? All right, good. All right, so we don't have any chocolates this morning, but we got lots to talk about with Berkshire. We're going to get into our panel, and I am so delighted to be on the stage with everyone here today. So I brought some props as well. Chris Bloomstran, as you know, doesn't really need an introduction. He's from Semper Augustus. He puts out this annual piece on his website, and I bound it because I like it so much. But it is a current Bible, and I mean, amazing stories in there as well. So I would encourage everybody to go to his website for that. Then we have Brett Gardner, who's on the end here. He's joining us for the first time this year. He put out this book, which just came out. You can buy that. It's amazing stories. One of my favorites is around American Express and the oil salad crisis. And then Adam Mead, who's put out the Bible, is joining us here again. Again, this is a must-have for everybody's shelf, and so I carry it around, and you can get him to sign it again and again. And then lastly, Pieter Slegers is joining us, and he runs Compounding Quality, which is a widely followed website with lots of great content on Berkshire Hathaway, so similar to how we all think here today. And then lastly, I just want to point out, I know you want to get to all the good questions, but we also came up with our own badge today, and on the back is the QR code, so please enjoy those. We took a page out of Berkshire's book, but we hope you enjoy those as well. Okay. Everybody had enough of that? All right, so let's get right into it. $318 billion of cash. We can debate all that. It's probably going up this quarter, give or take some tax expenses. Let's start with Brett. What does this all mean in terms of the hoarding of cash? Where do we see that going over the next year? And give us one company he should absolutely buy today with that money.
First, Mac, thank you for having me. Great being on the panel. I think the cash balance is just a function of what Buffett sees in the market, which is that he's just not seeing a lot of great opportunities. I'm hoping that he puts some cash to work over the past few months with the volatility. But my concern is that things didn't get cheap enough for him, so that cash balance is going to continue to grow and grow. In terms of companies that I think that he should buy 100% of, I'd actually love to see him buy IKEA one day. I think he's going to buy 100% of Occidental one day. I know the CEO was at a conference a couple weeks ago saying that it was like her dream. I think that's probably more the realistic one than IKEA is.
Yeah. Sure, before starting, I think I don't belong on the panel here, and I think you guys, Mac and Gabelli, is doing an amazing job. And I'm also quite sure that there are a few millionaires and probably multimillionaires here just because of Berkshire and keeping it for decades. So I just want to, if everyone is willing to give it an applause, and thank you, and thank Warren, and thank Charlie. We also did a lot, obviously. I'm from Belgium, so obviously I like the IKEA idea. It's a bit in the European field, but I think it also was Warren Buffett who said, well, anyone who says size doesn't hurt performance is selling. And that's also what we are seeing today. So for example, 400 billion in cash. That's more than the GDP of Belgium, and there are almost no companies that he can still buy, especially listed companies. All those kind of big tech companies are large companies, are technology companies, which aren't within the circle of competence. So my 2 cents would be, or I would think he might have bought a bit more recently, but that's still too soon for him to add. And I think the best thing that can happen, or the most likely thing as well, is that he just tries to keep adding as much as he can to his current positions. And from that perspective, I found it a bit odd that he sold some Apple last year. In hindsight, it was a great decision, obviously, so who am I to say something about Warren Buffett? But the reason I thought it a bit odd was because there are only a limited amount of companies that he can still invest in. And when he is reducing his stake in Apple, well, the big question will be in which other companies can he still invest that are large enough, that move the needle for Berkshire, and that are within the circle of competence?
Yeah, I mean, we're at this kind of unique confluence of events of having sold so much Apple, having so much cash on the books, but also having these other capital allocation avenues closed off. So equity markets, private markets, they're still pretty expensive. There's a lot of capital out there chasing deals. Berkshire stock is fairly or maybe even slightly overvalued at this point, so Buffett's not buying back shares. So everything's kind of closed in, and the checking account continues to build. Maybe we get a chance to see Berkshire buy all of Oxy, but I mean that's literally one year of operating earnings. So you'd have to buy an Oxy every single year just to keep stable. When you look back at Berkshire's history, in each of the decades under Buffett's control, the largest acquisition as a percentage of equity capital has been no less than 15%. So that held through all the way from the 60s up and through 2010 when they bought BNSF for $44 billion, which is about 18% of equity capital. So to make a similar size acquisition today with over $600 billion of equity would be $115, $120 billion, which, to your point, Pieter, is that universe is just so small. So, where we sit, it's just there's not many places to deploy it. Berkshire Hathaway Energy, if you look at their capital plan over the next 3 years, they plan to spend $35 billion on various projects, but all of that capital will come from BHE. So there's really not too much opportunity, unless we get a major project in the energy space, to suck some of that capital back from the parent company into Berkshire Hathaway Energy. So, I don't know, Chris, maybe you have an idea what they can do with all this cash.
Well, first, Mac, thanks. Mario, thanks. It's first time you had me come to this. There were a couple dozen people in the room, and look at this. We lost Charlie. Wasn't at last year's meeting. Warren's run, as he even points to the IRS mortality tables, is closing fast. But I hope there's a commonality as to why we all come to Omaha, and it's only in part what we've learned across the street directly from Warren and Charlie. But there's a community that likes integrity and the morality and the ethics of the way Berkshire was run. And so I hope decades from now we're still doing this and all the other events that have cropped up around the Berkshire meeting. It's the highlight of my year to be here. I think the Apple sale was brilliant. You know, Warren's pivots over time, stopping new cash flows into his partnership, eventually closing the partnership in '69, was a reflection of the stock market being rich. The general reacquisition at a point where Berkshire's stock portfolio inside what was largely an insurance operation at the time, the stock portfolio was 115% a book. Coca-Cola was 50 times earnings. They paid $1.3 billion for it. It was a $17 billion position by 1998. Had bought it after the stock market crash in '87. Buys Gen Re with Berkshire shares, diversifies from a very concentrated stock portfolio, picked up 45% of the merged assets came from Gen Re, and they were bonds. And so the allocation to stocks went from 115% a book down to 65% a book, 70% of assets down to 30% of assets, and de-risked Berkshire. Well, I look at Apple the same way. Warren builds up what was over a billion share position starting in 2016, got $35 billion, $36 billion invested. Had he not sold any of it, it would have traded as high as $250 billion. But he originally sold, if everybody remembers, he sold 100 million shares in 2020. And both he and Charlie lamented the sale, said it was a mistake, and effectively intimated that the Apple position would be kind of one of Berkshire's permanent groves of value. So the stock continues higher, and as we all get older, we get inflexible. It gets harder to change our minds in life and as investors. But he proceeds to start selling the Apple position down and shrinks it down to 300 million shares. So all in, he has sold 70% of the position. It's still Berkshire's largest holding, but it would be well over half of the equity portfolio today, similar to where the Coke position was in 1998. And some have said, well, this was a market call. I don't think it was a market call. I think it was Warren saying, here's a company that's growing a 6 or 7% top line, that net margin's probably not going to get much higher than 30 or 27%. You can't pay 36 times earnings. You can't own that business at 36 times earnings, even net of what's going to wind up being a 21% tax when that cash goes out the door either this quarter or maybe even we'll see it in the second quarter. Some have even said that the Apple position was sold to clean the portfolio up for Greg and for Todd and Ted. Well, that's also nonsense. I mean, that's not I don't think that's the way Warren thinks. This was simply, I've got a position that's too expensive. I don't have anything immediately to buy with the proceeds. So, I'll sit on a mountain of T-bills. And so you've got 27% of Berkshire's assets in cash. The cash position since the Gen Re deal in '98 has averaged about 13% of Berkshire's total assets. So it's double that today at 27%. But even in '04, '05, cash was 22%. So even though $318 billion or whatever the number is sounds like a gargantuan sum of money, it's really not compared to the nearly $1.2 trillion of Berkshire's assets. $100 billion of that cash is going to sit around permanently in the insurance operation as reserves. They've either got to own bonds or cash to support the different underwriting operations. And so to all these guys' points, they're exactly correct. This is still, Berkshire's an enormous operation. And so you think about the 100 biggest companies in the S&P 500, I think the 100th is probably 85 or $90 billion in market cap. For Berkshire to peel off a 5% position on normalize the stock portfolio, not at today's $260 billion, but say $400 billion if they were to fully invest the equity portfolio, that's $20 billion. You've got to buy 23, 24% of the 100th biggest company in the S&P. So I think I'll stop, but if you go through the list of the largest publicly traded companies and you think about how Warren's mind works, there may be a dozen companies that I think he'd be comfortable buying entirely. You could perhaps own all of American Express. It's already been the largest shareholder forever. Visa, MasterCard be candidates. A company like Lindy would fit well inside Berkshire. Bolting in Gen Re, bolting in the Alleghenies, 3 insurance companies, hard-pressed to find property casualty insurer or reinsurer that would not be better off inside of Berkshire than it is run on a standalone basis. There are huge advantages to Berkshire growing its insurance operations. They don't have to lay off risk in the retrocessional market. So there's a list of 10 or 12, and we could probably all spot them. And Warren is, I'm sure he's praying that the trade war gets worse. He won't say that publicly, but Berkshire needs a crisis. I mean, Berkshire thrives in crisis. And he even said, I didn't do 08, 09 as well as I could have. I got the $5 and the $3 billion in GE and Goldman. But I mean, he and Greg and whoever's running the show, I think are chomping at the bit for any bad news to come, which to me is the right way to look at the world.
Okay, I just want to do a follow-on here. And I think if we just take Warren's action about the buyback, he probably thinks there's a premium valuation in his stock today. We haven't really talked about, over the last decade of potential deals with stock. Do you think that's a new pipeline, that there are companies out there, family-owned, where they would accept a liquidity discount, the tax advantages, and now that there's a premium in the stock, that might be a way to narrow the bid-ask potentially, going forward? And, also, the new tax dynamics we'll know in a couple of days, so we'll have some. I guess it's just a kind of a playbook that we haven't considered because we have been dealing with a theoretically undervalued currency going forward, but arguably that may be different, and this the ability to buy at a discount because of those tax benefits and the currency that might be open to some other things today. Would you agree with that, or any comments on?
I think they'd be very reluctant at this valuation to issue shares. I mean, even fully slightly overvalued, where I put it. Historically, it has been 150% a book, 200% a book when they've issued shares. But maybe under the right circumstances. I didn't mention a company that they could potentially buy, but one that comes to mind is Old Dominion Freight Line. I mean, there you have a family-owned company, the Congdon family. If they were willing to part with their ownership or give up 80% of it for some Berkshire shares, and if it made sense, as long as Berkshire's getting the value that they're giving out in stock, I could see them using it as a currency. And there you have a business, the less than truckload or LTL freight business, well-defined moat, but pretty capital intensive, so it can really soak up some of Berkshire's capital. So that's one that comes to mind.
I think it's unlikely he uses shares at today's valuation, but I wouldn't rule it out entirely.
Warren has said of late that even with Gen Re using the shares as currency was a mistake. What he means by that is spent $22 billion worth of Berkshire shares, 272,000 shares, I think. Well, they were trading at 3 times book. They were worth half that. And I think he'd privately admit that the reason he did it is the shares were expensive and I was getting way more than I got. He did spend $1 billion of shares to buy in the little piece of Berkshire Hathaway Energy from Walter Scott's estate. Most of those shares wound up in the foundation. At a price, if you look at Berkshire's history, Warren knows, and I think Greg will know, when the stock is expensive and when it's cheap. Prior to buying Gen Re in '98, there were a series of 7 or 8 companies that they bought in the 1990s with the stock trading at north of 2 times book. Flight Safety, NetJets, Dairy Queen, Hellsberg, there were a bunch. So here you are with the stock really kind of at my appraisal of intrinsic value. If you were to trade north, there aren't, again, back to the earlier conversation, there aren't that many companies they could buy, but an SC Johnson, private held in this country, Koch Industries might be a candidate, Cargill could be a candidate, and by using the stock, when you've got these families that have generations of inheritees, oftentimes with low cost basis, by using the shares, you avoid the capital gains tax, and so the shares would become attractive. They just need to be sufficiently fully valued, is probably the right way to say that, to use them. And you need to have families that are willing to accept them. But I think at the right price, it becomes very viable.
Obviously, one of the things we'll hear about tomorrow is the insurance businesses. Certainly a fantastic year for the organization. It still looks very encouraging going forward. Maybe we'll start with Chris here. How do you feel about the outlook for 25? And maybe you could just unpack some of the elements last year, maybe Gardner Insurance to highlight, Geico, et cetera. Just State of the Union on your outlook there, what you saw last year, and why it's a strength for the firm.
Property casualty insurance and reinsurance is generally a pretty lousy industry, as most of you guys know. The businesses don't make a lot of underwriting margin. Returns on capital are tough. It's cyclical, so you have times at which there's too much competition for the next dollar of premium volume, and you have a lot of people that are willing to write business at the wrong prices. Berkshire's been so disciplined to not do that over time, and that's really been their advantage, and that allows them to have a bigger stock portfolio than not. Last year was incredible. Last couple of years, take Geico. The auto insurance business was terrible coming out of the pandemic. It was great during the pandemic because nobody was driving, and in fact, the regulators in each state made the companies give money back, but very shortly had the inflation in the system. Losses developed very badly. Fixing cars was expensive. Fixing people was expensive. You had more days of rental units. So the industry went from more profitable than it had ever been to losing more money than it ever had, and it took a while to get price. Well, Progressive cut advertising spending. Geico cut advertising spending. Geico lost a lot of policies in force. Progressive, even though they cut ad spend, managed to maintain and even grow policies. So a couple of years ago, Geico was still the second largest auto insurer in the country to State Farm. Progressive has passed them, and there's about a 4 percentage point market share swing that Progressive has picked up, and Geico is trying to fix things like telematics. But given the fact that they finally got price in bad states like California and more socialist-leaning states, the industry in auto, in the specialty lines, was very profitable last year. The auto business, Geico underwrote at 82.5, and they'll normally make a 4% margin is kind of what both they and Progressive target. So they're fixing some of the issues. To me, the cycle is getting pretty long in the tooth. I would have liked to see the Chubb purchase done maybe a couple of years earlier when the stock was cheaper. We're at that point in the cycle where in reinsurance, you're no longer getting price increase. Premiums have kind of flattened out on the January renewals, and things are going to get a little tougher in insurance. But they made so much more money last year than anybody would have anticipated going in. It was just a mountain of riches, and it should still be a good year. And then, of course, in CAT and the reinsurance business, depends on how storms develop later in the year. There were very few storms that cost the industry and cost Berkshire a lot of money. So the insurance operation made $9 billion last year, and on $90 billion in total premiums across all of their lines. In my world, they kind of make a 5% pre-tax margin, so $4.5 billion pre-tax. So more than double that last year. And so things were better than they'll be, but there's no better group of insurers in the world. And again, crises are good. So you don't mind bad markets because a lot of capacity goes away.
Yeah, we've seen over Berkshire's history these cycles, as Chris mentioned, tightening, hardening markets, loosening markets. I have no doubt that Berkshire is going to find something intelligent to do at some point. Again, you look at Berkshire's history, I think it was 2000, mid-aughts there, 2007 maybe. They did a reinsurance deal with Equitas for a couple billion, took out some risk from Lloyd's of London syndicates, a couple similar deals over the next decade, culminating in, I think it was and still is the largest retroactive reinsurance deal with AIG in 2017 for $10.2 billion. So Berkshire tends to get its bite of the apple eventually. So it'll when conditions are loose, it will let others go out, write those policies, get what they think is a appropriate premium. When things start to blow up, Berkshire will step in and do a big reinsurance deal. So we saw or heard last year Ajit saying, I think it was 40% margins he quoted on cyber insurance. Well, maybe something in the cyberspace blows up and Berkshire comes in with a retroactive reinsurance deal, and there they almost don't care what the risk is. They structure the policies with a defined cap, and so it's really just a matter of how much cash are we getting in the door for the float, and what is that duration of payout for over the life of those policies. So something will happen at some point, and when the conditions are right, like a couple of years ago in Florida, writing $15 billion, I mean that can happen in an instant. So Berkshire's very well positioned in insurance.
Obviously in insurance it's all about the risks and probably the nature risks as well. So it's all about the long-term risks. You will receive premiums today for a risk that might happen in the future. I think it's it's similar to the stock market, meaning what will the stock market do in 2025? I don't know. What will the stock market do in 2026? I don't know. But probably, and let's all hope, in the long term it will go up and it will add value. And the same is true for the insurance segment of Berkshire. It has helped them tremendously over the past few years, and I think it will continue to do so. And also to give another example, which to some extent is linked to Berkshire, but disclaimer, I own the company, and other disclaimer, it's no investment advice. One company I think is really interesting is Kingsale Capital, and to some extent they copied the playbook of Berkshire Hathaway. So you have the same Mike Yu, the founder and CEO. And more specific, well, they're active in E&S insurance, so excess and surplus lines. So those risks are higher, the risks are higher than traditional insurance, but it's also growing at higher rates, which is interesting. And it's funny because I read everything Warren Buffett has said and written twice now. And when I first was reading about Kingsale Capital, it actually really reminded me about what Buffett said about Geico 30 years ago, 40 years ago. And the interesting thing there, it's in the insurance, it's all about the combined ratio. So when you're able to have more data and analyze those data better than your peers, well, your combined ratio will be better. As a result, you will be more profitable. And for Kingsale Capital, for example, you have a company that is active in insurance, more specific E&S insurance, which is growing at rapid rates or faster than the general market. And it's a company just like Geico, for example. That's why I made the reference. They are planning to double their market share over the next 10 years. And then you get some kind of flywheel that keeps rolling. And with an insurance company, obviously you receive premiums, and then you need to invest them. Usually it's in bonds and equities. And last time I met him as well, I asked him, well, it's still a small company right now, but I asked him, well, currently all the equity investments are outsourced to BlackRock. And I asked them, well, when are you going to do this in-house? And Mike Yu said, well, I think we will do everything in-house when the assets under management or the amount we have to invest in equities triples from today's size. And it might be sooner rather than later. So it's a very powerful combination to use those premiums and invest them. And in the long term, I think it will continue to be a win.
Yeah, I don't think I have anything to add to what everybody else said. I don't have a strong view on the 2025 outlook itself, but over the long term, I think Berkshire will find interesting things to do.
You want to circle back on Gard?
Yeah, Mac had asked about Gard. Despite 2024 being one of the best years in the insurance industry, there were a couple deals and a couple issues that popped up. One, Berkshire had bought, and Ajit, I think specifically, bought several years ago, talc manufacturers that were no longer operational. And I think what they were doing was inheriting some marketable securities, letting losses for asbestos and talc develop, and you'd have the use of the float effectively for a period of time. Well, with the inflation and medical costs that you saw in the last 3 or 4 years, they wound up taking about a $500 million charge. That's something you want to see Ajit address, maybe a little more of the color as to what was the thinking behind that deal. How much did you earn over the handful of years before you took the charge at the end? Was it a good deal? Was it a bad deal? My guess is because there was a charge, it probably wound up being not as profitable as they thought. But Ajit gets to do these one-off things that are creative that have added a lot of value to Berkshire. But the other that really jumped out Berkshire bought Guard Insurance inside of its primary business 20 years ago. They were pretty small at the time, doing $400 million in premiums. You know, the business has grown to $4 billion in assets, but they took a $700-ish billion charge, net of $500 million of reinsurance recoverables, and fired the management, replaced management, which is pretty unusual in Berkshire's world. So this is on the insurance side. Guard writes specialty insurance for small businesses. They were writing homeowners business, and homeowners got really tough in places like California. But in a very tough year, to see a business take a $700 million charge and replace management goes to the fact that A, this is a tough game, B, Ajit, Greg, Warren are on it, and when you've got an issue, you've got to fix it, put it to bed. But they ran off the commercial, they ran off the homeowners book and had a business that, despite it being a great period for insurance, they had to fix and repair. So it goes to it being a tough game, and you've got to have the right management in place in perpetuity to ensure that when you have problems like this, you address them pretty quickly.
So we're going to ask another question to the panel, but we're going to then go to the audience for questions. So we have two people helping with the mics in the room. And so if you want to ask a question after this one, then just kind of give a notion. We'll get it so we're quick on that. All right, guys. On the operating front, we can't avoid the T word, trade and tariffs. Berkshire has U.S. businesses, but well influenced in the American economy. Maybe you could we'll start with Adam. Just go through some comments about the tariff, how they may impact Berkshire, and whether I'm thinking there's an opportunity if we do get some more disruption across certain businesses, that might be an opportunity for capital allocation for them as well.
Yeah, where to start? First, tariffs, they're just massively stupid. Other than that, I have no opinion. But, it's just the tariffs themselves, the disruption, the uncertainty. Berkshire will be impacted negatively. I don't know what that net will be. I think it will be a net negative. Berkshire generates about 86% of its revenue in the United States, but of course, it's the cost side of it that impacts things. And the first business that comes to mind is something like the furniture stores, Nebraska Furniture Mart, some of the other furniture retailers, and those entities will be hit directly just by virtue of higher prices and lower volumes. Then you look at BNSF, West Coast port container volumes are down 45%. That we might get a spike up temporarily with this reprieve, and then who knows? Is that an air ball from there? So that could impact BNSF. And you kind of just go down the line. I think Chris mentioned Geico and repair costs with auto. So if Geico is priced a 6-month or a year policy based on yesterday's repair rates, and all of a sudden repair costs are who knows how much higher, that's going to impact the combined ratio. So that could trickle through. I think the energy business is largely insulated, although I don't know to what degree. It'd be interesting to hear from Greg to what degree the certain infrastructure for projects like, say, solar come from overseas. So you've spent 10 years in some cases getting a project permitted, dealing with landowners, and you finally get to the finish line, ready to put this capital to work. You built your models on returns, worked with regulators, and all of a sudden your input costs, again, question mark how far that goes up. So, could affect some of the viability of the projects in the energy business. It really is a big question mark for me, and I'm sure there'll be some positives along the way, but I'm of the opinion that it'll be a net negative for everyone, and Berkshire along with that.
I can talk about this a bit from a European perspective. I think exactly the same as what you said. Nobody understands the rationale about the tariffs, and I think it's a bit like a real war. World War I, World War II. This is a trade war to some extent, and nobody wins. So it will be bad for our the US, will be bad for Asia, will be bad for Europe. So nobody is winning in this one. And it has a lot of negative consequences, obviously. For example, from the US perspective, I don't think it makes that much sense to produce shoes, for example. I don't think we can produce shoes for $2 or $3 and do something like that. So tariffs will cause higher inflation, higher unemployment. A lot of things will getting more expensive. So I don't think protectionism is a great thing to have in this world nowadays. And one quote, and I'm paraphrasing here from Warren Buffett I love, is basically when you look at the Dow Jones, for example, and you start investing at the beginning of the 20th century, well, since then we've had 2 world wars. We had the Spanish flu, we had the COVID pandemic, we had the dot-com crisis, we had the financial crisis, and you can keep going on. And yet the Dow Jones rose from 66 points to over 40,000 points today. So the only person or the only thing that can happen that you aren't going to succeed as an investor is yourself. So let's just see what happens. I don't think it makes a lot of sense to put a lot of thoughts on things we can't control. Let's just focus on things we can control, hopefully try to buy those wonderful companies at a fair price. And then in the end, we will be fine, but it might take a bit longer when the tariffs start to play out.
Yeah, I think the tariffs increase the probability of a recession coming, obviously, which will be negative to Berkshire's operating earnings. But it also, in my view, probably raises the probability that the markets will crack a little bit and give Buffett an opportunity to buy something interesting. But it's obviously mostly negative. Buffett was interviewed a few weeks ago on, I think it was CBS, where he said, tariffs are an act of war. So I don't think he, to Pieter's point, so it's definitely not something to take lightly. And I think we'll obviously, I don't think there's any upside to Berkshire's earnings. The only potential upside is if markets crack and gives Warren a chance to buy something big.
I've been eating a lot of popcorn. I don't even like popcorn, trying to follow these tariff issues and what's going on with trade. Hopefully you give the administration the benefit of the doubt and you ultimately wind up with matching tariff rates on exports and imports to each country. But you take a shoe example and you take Vietnam, a tiny country, and you wind up with a 46% tariff rate as originally proposed. We're not going to make shoes in this country. Vietnam's a small country on GDP per capita. We send them $10 billion. They send us $130 billion of electronics and coffee and shoes. We're not going to make shoes. Vietnam immediately says, we'll go to zero. Well, whatever, that's zero on $10 billion. That's nothing. But the White House said, no, that's not enough. Well, how could zero not be enough? And I think what they're getting at is this is really a China issue. And to the extent Chinese electronics are having a final solder done in Vietnam, and Vietnam is exporting to the United States and calling it a Vietnamese product, not a Chinese product, I think that's where the White House is going, but they're manic. This is a little bit crazy. All I'll say in Berkshire's case is, as I said earlier, tariffs, trade wars, recessions, depressions, financial panics, pandemics, these are a net good for Berkshire. When you're sitting there with $200 of $300 billion of deployable cash, you want a little bit of excitement in the global economy.
That's only if the tariffs are reversed, right? I mean, if you get some disruption in the market, Berkshire can swoop in, buy some companies, and then the tariffs, go down to maybe what they were before. That's fine. But net, would you say, in terms of operating earnings, Berkshire is going to see a decrement in terms of earning
the
power?
retail operations will be impacted. You'll have to pass through some of those costs. But to your point, the railroad is, other than a net decline in trade, but trade's been in decline for 4 or 5 years anyway. The Chinese economy has really maxed a lot of our car loadings in the Class 1 rails way beyond coal have been in decline. So I've got in my letter a section that has total exports, total imports. We've been in decline in trade for 4 or 5 years, and I don't see that trend reversing. The other comment I'll make on tariffs is I don't think they're as deleterious to the economy as one would say. A lot of economists say tariffs were terrible, they caused the Great Depression, or they made the Great Depression that much worse. Well, Smoot-Hawley didn't hit until June 1930. We were already 9 months in. The stock market had already been crushed. Unemployment was already surging. And tariff rates were already 13.5%, and the White House at the time moved them to 20%. But trade at that point in time, the United States was a slight net exporter to the tune of 40 basis points, so we were roughly right on this, but 5.4% exports as a percentage of GDP, 5% imports as a percentage of GDP. We exported a lot of ag, but even Friedman will say, I mean, Smoot-Hawley and tariffs had a little bit of an impact on making the economic downturn worse, but nowhere near as gets broadly advertised. So, if you have a 46% tariff on shoes, Hoka, Decker Outdoor, which got cheap, Nike, they all make all their shoes in Vietnam. You're looking at a 6 or 7 or 8% price increase. Some brands can handle that, some cannot, and Berkshire will be impacted, but I'd rather be impacted on the operating margin at some of Berkshire's retailers and be able to spend $200 billion on some entire businesses. I mean, what happens with this cash is what's going to move the needle at Berkshire and bring on a little pain.
All right, why don't we go to the audience? We have some questions. Okay. Do we have our mics? Oh, here we go. Sadie. So when you ask your question, please give your name, and if you could make the question pretty quick, succinct, please.
Hey, my name is John Norwood with TBL Ventures. I have a question about international markets to the panel. Where should we be looking in terms of deploying capital in international markets, whether it's Europe or South America? What about India in particular?
We'll start with Brett. Just go down there.
The question was about
around international markets. Where should they be deploying capital? Investors looking globally to invest capital.
Yeah,
recommendations.
I think they should. Kind of obvious answer is you should deploy where you find the best opportunities, which is dictated by the valuations in specific markets and also kind of the corporate governance, rule of law, that type of stuff. I don't think Berkshire is probably going to be doing a lot internationally as long as Warren's alive. Maybe a little bit, but not much.
Interesting one as well. I'm living from a Belgian perspective, and this will probably surprise people. Performance past 5 years, S&P 500 more or less doubled. Berkshire Hathaway plus 190%. Take the Belgian stock market, for example, it's more or less flat over the past 5 years. So I think two key differences are, on the one hand, for example, for Europe, valuations are way cheaper than in the US. Often you can find companies that the average PE is 10, 11, 12 times earnings. But one of the key differences as well, on the other hand, is the US has way better businesses, meaning they are way more profitable. The growth outlook looks way better. They have a healthier balance sheet. And when your company doesn't create any value over the past 5 years, it makes complete sense that you are also not generating any returns. So yeah, from my perspective, obviously everyone's investment philosophy is unique, but I think it's just that the European companies try to focus a lot on the profitability, on the capital allocation skills like the return on invested capital, and try to find those companies in a secular trend. And you will notice there are not that many companies in Europe doing that. There are a few, and often you can buy them for 15 times earnings, which is interesting. Another really interesting market, obviously, is India. I wouldn't consider India within my circle of competence, but luckily nowadays you have a lot of ETFs or fund managers with a great track record, via which you can play these kind of ideas.
Yeah, I mean, Berkshire will, as the Japanese investment shows, I mean, if there's value anywhere in the world, Buffett will go there. But Berkshire has operations internationally. I think I mentioned earlier, 86% is the U.S., so about 14% internationally. They own Berkshire Hathaway Energy has Northern Power Grid in the U.K. They own a little company in Germany, Detlev Louis. It's a motorcycle gear retailer. IMC, based in Israel. That was I think a $5 billion acquisition at the time, and has grown. There's opportunity around the world. I think Buffett does prefer the U.S., but They absolutely could and would go internationally, I think, if the opportunity was right.
I think everybody knows the U.S. has been the place to be for the last decade and a half, completely outpaced most of the developed and the developing world. You could say the same for U.S. large cap versus mid cap companies, small cap companies. My comment is, Europe, for example, with their regulatory morass, there are a lot of reasons they're cheap. They're just not allowed to innovate the way we do. The United States has been structurally a better place to be. We have the capital-light businesses that probably couldn't exist in Europe because they just don't have the innovation. They're really not allowed to innovate the way we do. But that said, when you look at small cap, mid cap, international, this to me is a period where there's so much value outside of U.S. cap-weighted indices that the next 10 years are a stock picker's market. So if I were an allocator, I wouldn't allocate broadly to Europe or to emerging markets because I don't think there are that many good businesses. But if you're a bottom-up, rock-turning stock picker, we've got 20% of our capital invested outside the United States, largely in Europe. Most of those positions we don't disclose. And there are some incredibly well-run gyms. What you find in Europe and even in Japan is they're much more shareholder-friendly. You don't have excessive executive compensation, use of restricted shares, option shares. The accounting tends to have more integrity across the board. But you've got to do it on a company-by-company basis because there aren't that many great businesses. But to the extent there are some great businesses outside of the cap-weighted U.S., it's one of the widest degrees of bifurcation that I've seen really since 1999. There's a lot more opportunity if you're not a passive owner of the S&P 500. The advantages to being a stock picker, to me, are as great today as they've been at any time in my 35-year career.
And I would just add, tomorrow we'll hear about American Express. 25% of their business is overseas, 25% ROEs, and we know those businesses. Japan, Europe, they're growing 13%. Domestic business growing, 7 to 8%. And so there, if you like overseas certain areas, you can allocate to a company, a very strong fundamental base, and you get their capital allocation expertise and history of execution there. So the model works, and you get faster growing regions, you get their expert ability to allocate there and the returns. So I think it's also good to look at companies where you like those geographical or some components of their businesses overseas, and you can still invest in them at a 15 to 17 times earnings here in the U.S. Our next question.
Hi. Talking about the global market opportunities, what do you think of Canada? Right now that I've heard some theories that Warren is actually looking at some industries in the long term, no matter this administration or the next one, no matter where the winds go to. And then let's look at the north of the border. There's a new prime minister coming up as well. And there's a lot of great opportunities for Canadian companies in terms of energy, global warming, and you name it. But I would like to just hear your opinion regarding Canada. Thank you.
That question was asked last year, and Greg's from Canada. And Warren and Greg both said, we love Canada. There are opportunities. There aren't a lot of businesses. Canada is 1/10 of the size of the United States by population. There aren't a lot of big public companies. I think your question, to your point about energy and infrastructure assets, would be a place that's right up Greg's wheelhouse, and they're looking, and I wouldn't be surprised to see deals done in Canada. They've done deals in Canada already. Altalink, I wouldn't rule it out at all, and hopefully our relations with Canada, which have been phenomenal for decades, are a little bit frayed at the moment, but I think we'll get through this.
I'll just channel my inner Charlie, nothing to add.
I also tend to agree with Christopher, meaning Pieter Lynch, whoever turns over the most rocks wins. And for me personally, I don't care whether the business trades in the US or Canada or Australia or the UK. It's just about finding those great companies. But one thing that I also find really interesting in general, and that makes me a bit worried a bit sometimes. In general, economic growth is basically driven by two large factors, economic growth and the growth of the working population. One issue we're having globally is the growth of the working population is decreasing. So all GDP growth will need to come from the productivity growth, basically. And hopefully AI can be a huge factor in that. But when you factor in, that's basically how you get to the average return of the stock market. If you have a GDP growth of 3-4%, you have some operating leverages for businesses, meaning you get to 5-6% in earnings growth, plus a dividend yield of roughly 2%. You come up to 7%, and that's more or less the average return of the stock markets over the past 100 years, 150 years. So hopefully, we can continue that GDP growth, because that also will be obviously a very important thing for stock markets, for the stock market performance and earnings growth of those underlying businesses.
I think my only comment on Canada is I don't think it's going to become the 51st state. I think Chris is right. They have a lot of interesting energy assets that I'm sure Berkshire is looking at. But I have a strong view on the market. I mean, some companies in there are interesting.
All right, maybe I'll take this next one. Again, it's a little more focused on Berkshire, but so this is a two-parter. Tomorrow, we'll get some feedback on some of these core companies. You know, we mentioned American Express, et cetera. Maybe you could just discuss, we'll start with Brett and talk about what is the forever business now for Berkshire, because we've seen sales of Apple, et cetera. And secondarily, now that we know Greg Abel is taking more control of the capital allocation, what do you expect in terms of some of those companies? Could there be any changes to the portfolio just based on his ascendance as well? So, the core portfolio, any risk to them, given some of the sales by, Apple, and then what does it mean to have Greg kind of being the chief allocator?
Sure. So I think the 100% owned businesses are going to remain. I don't think Greg is going to divest anything. In terms of the common stocks, I think it's kind of contingent on valuation. Like Apple, Warren sold Apple because the valuation got very stretched. And I kind of expect that same philosophy to apply to the other stocks as well. I think that when Warren passes, maybe not within the first couple of years, but I think eventually Berkshire is going to institute a dividend. I'd have to expect a larger repurchase program when Warren passes. I could see, perhaps buying some of the stock back from the foundation, for example. I think those are the bigger capital allocation changes once Warren passes.
Obviously, Berkshire Hathaway is Warren Buffett's life work, and it's some kind of continuous painting that he keeps expanding and expanding with every new business he buys. So, say for me, I'll probably just expect more of the same. A bit like the discussion we had in the beginning, it will be hard for Berkshire to find interesting investment opportunities that are large enough for them to move the needle. And those kind of opportunities will probably be in the non-listed space. So it depends. When, for example, the stock market would crash, I would just expect Berkshire to keep buying and adding to their existing position as much as they can. Maybe it might make sense to start buying back shares again when something like that happens. I personally would prefer that over dividends, because it would also be a signal that they can't find any interesting investment opportunities anymore. It's like the $1 test. For every dollar in returned earnings, you need to create more than $1 in value. So hopefully they will keep succeeding in that and adding to existing positions, maybe buying back some shares. Tend to agree with Adam that the stock is overvalued a bit right now, but when the stock goes down, might make sense to add to or buy back shares and create a shareholder value that way.
Yeah, again, excuse me, going through Berkshire's history, I mean, it's interesting. We've had a number of these forever businesses. If you look at the early history, one that comes to mind is Scott Fetzer. When Berkshire bought that company in 1986, it doubled its revenue base. And I think January 1, 2024, that business got folded into Marmon. So, here you have this massive acquisition at the time, it has become almost less than a footnote. So when you think about a forever business, I mean, I tend to think along the lines of biology, these sort of natural growth and decline cycles, and that's okay in Berkshire. Buffalo News, Berkshire bought the Buffalo News in 1977. For a good decade, 2 decades, it was earning its purchase price every single year. That business was sold in 2020 as part of the Berkshire Hathaway media group. So Berkshire kind of harvested its cash in the early years, and when you think about the time scales, analysts, whether explicitly or implicitly, like to you include a terminal value. Well, today is the terminal value of 20, 30, 40 years of some of these businesses. So I think it's natural to have these cycles with businesses. There's only so much that Greg can do. He has done, if you look at the margins in the MSR businesses, for example, he has, I think that is a hand of Greg, improving some of the margins in those businesses. But nothing will, Greg is not a magician. He can't fight some of the economic realities of some of these businesses. But I have no doubt that in 5, 10 years, there will be another forever business, and whether that actually turns out to be forever in the case of a Coca-Cola, or if it turns out to be something like Apple where we sell it down, that's okay.
Forever business is a tough term because the economy is dynamic. We all know Semper. But Berkshire's got as much durability with its 3 largest businesses as probably it could be imagined anywhere in the world. Berkshire is still an insurance operation, and it's largely a reinsurance operation. Half of the assets, the marketable security portfolio, are almost all in the insurance operation. That's nearly $550 billion of assets. Berkshire's valuation in insurance only slightly comes from underwriting, from making a 5% pre-tax margin on $90 billion in premiums. What Berkshire earns on the investment portfolio dwarfs what they do on the underwriting side, but the key to Berkshire's operation is underwriting conservatively and not writing bad business when it's mispriced. Nobody else does that. I mean, they're the only insurer that's consistently done that over decades. The big European reinsurers don't do that, and for that they can't have a stock portfolio. So as long as Berkshire's conservatism persists in insurance, it will continue to distribute cash. With the Apple proceeds, Berkshire sent $70 billion as a dividend from the insurance companies last year to the parent to do something else with. 20 of that's going to go to the actual cash going out for taxes. Then you move to the energy operation, $50 billion of equity, earning 10% regulated returns on equity. The risk to that business is public policy shifts from what we've been doing in renewables. One of the great advantages to Berkshire's energy operation is the ability to reinvest everything they earn and build out the wind and the solar and the grid that goes with it and get a regulated return on that. If public policy shifts and we stop doing credits, Berkshire picks up $2 billion in credits to finance its renewables portfolio. And if we say we're not going to do wind and solar and the grid on the scale we're doing it, that simply becomes not a home for that incremental $2 billion, which would be too bad because Berkshire can spend it in a larger scale than others. And then you've got this railroad that they bought in 2009, closed in 10 for $33 billion. It's worth something like $120 to $140 billion. Almost everything that business has earned since Berkshire bought it has been upstream to the parent to do something else with it. It's better business than it was prior to 2009. The industry earns more on capital, but there are some progressive things that have happened with regulation where I don't think that business gets any better. And it could get regulated to death, and Greg would be in a position to say if we're going to regulate something like a railroad to death, even though the railroads are going to be around in 100 years, moving freight, moving commodities, moving ag, Berkshire will own that asset in 100 years. But if the dynamics and if the economics deteriorate, you wouldn't rule out Greg and the board spending something like that off. But those 3 pillars of value, that's 80%, 90% of the value of Berkshire Hathaway, and those are permanent stores of value, and nobody else has that.
Well, on that note, we are concluding our panel here today. Thank you, everybody, for coming.